Hello, option traders. Welcome to SensaMarket. In this quick tutorial, I'm going to walk you through the platform's functionality and give you an introduction to options strategies. First, head over to the Options Strategy tab. Here, you'll find over 100 pre-built trades. And of course, you can also build your own custom trades using the strategy tools provided. One thing to note, each strategy is clearly labeled as bullish, bearish, neutral, or bidirectional, making it easy to identify the market outlook each trade is designed for. Let's start with something simple, a long call. Just click on Long Call, and the platform instantly loads the position for you. Keep in mind, everything I'm showing you today is using the paid version of SensaMarket, which includes advanced functionality not available in the free version. So, with our long call position loaded, the first step is to enter the symbol you want to trade, like Tesla, Apple, or any other ticker. For this demo, SPY is already loaded. Right now, SPY is trading at $594, and we're modeling a long call using a 33-day expiration, which in this case is July 25th. The call option selected is at the money, with a strike price of $594. If we scroll down, you'll see the P&L diagram, the profit and loss graph for this trade. You can slide the date to the left to represent today, or move it forward, say to July 3rd, to see how the position might evolve over time. This visualizes how time decay impacts your trade. As time passes, if the stock doesn't move up, the option can start to lose value. That's theta at work, the effect of time decay. You can also model changes in implied volatility. Just adjust the settings to see what happens if volatility increases or decreases. This helps you understand how sensitive your trade is to changes in market conditions. And if you want a broader view, you can expand the price range on the graph. For example, if you want to see what happens if SPY rises to $708, just zoom out to adjust the view. Lastly, it's worth noting that all pricing and modeling updates happen in real time with the paid version. If you're using the free version, there's about a 15-minute delay in pricing data. A couple of other key things I can look at here, in addition to adjusting volatility and sliding the date, is simply using the slider up and down on the graph. Now, I want you to notice a few things. If I slide it up here, for example, it will show me right at the top what the current market price would be. In this case, it shows $596. When I say the market, I'm referring to the underlying assets price. That would represent about a 0.5% increase. But in addition to that, down below, it also shows the probability, the percent chance of the price going above or below that level on this specific day. So based on the current Muller on the day I'm looking at right now, there's about a 46% chance that the market will go above $596. Another thing I want you to look at is this entire section across the top. This shows us some key factors about our trade. First, we can see the net debit. This is what you're paying to enter the trade. Since one option contract represents 100 shares, and the cost here is $14.02 per share, that means you're paying a total of $1,402. That also represents your maximum loss. So whatever you pay for the long call, that's the most you can lose even if the stock goes to zero. Now, the maximum profit is technically infinite. In other words, as long as the market keeps going up, your profit potential keeps rising with it. Currently, this trade has about a 32% chance of profit. Another key factor to understand is the break-even point. In other words, if I buy this particular option and hold it until expiration, I need the market to move up enough to cover what I paid. Since I'm spending $1,402, the market needs to move about 2% higher by expiration for me to start seeing a profit on this long-haul position. Now, let's talk about option pricing debit bid, the highest price someone is currently willing to pay for this option. Debit mid, the midpoint between the bid and ask. This is often considered the fair value. Debit ask, the lowest price someone is currently asking to sell the option. You'll usually pay something close to this. Another useful tool available here is the option Greeks. Let's take a look at those. Delta, this tells you how much your options value will change for every $1 move in the underlying stock. For example, if delta is 0.5484, that means for every $1 the stock goes up, you gain about $54.84 in option value. Theta, this represents time decay, how much value your option loses just from time passing. Here, theta is minus 20.78%, which means you lose about $20.78 per day, all else being equal. Gamma, this measures how quickly delta changes as market changes, means a high gamma, your delta gets more powerful fast. Vega, this tells you how much the options value changes if implied volatility increases. Vega is 72.86%, and implied volatility rises by 1%. Your option value increases by $72.86. More volatility equals more value. Rho. This measures sensitivity to interest rates. If interest rates rise by 1% and rho is 30.15%, your option value increases by $30.15. This is not super important for short-term trades, but can matter in long-term positions. Now, I want to show you something else, and that is the ability to plot out delta and see how it changes over time. You can also plot theta and observe how theta decay happens as time passes. For example, with this bowline here, we can see how much of our theta decay occurs halfway through the trade, and how much of the position's value will decay by the time we reach expiration. You can also view all the Greeks here, including gamma, vega, and rho, and how each of them behaves over time. Now, the next thing I'm going to cover is this set of buttons up at the top. Let's start with adding a leg to our trade. Right now, I only have a long call at $594, and as we saw earlier, I'm spending $1,402 to enter this trade, which is also my maximum risk. So what can I do about that? Well, let's say I believe the market might not go much higher than 594 call between now and July 25th. In that case, I might consider selling a 600 call to reduce the cost and risk. To do that, I simply click to add an option, select sell call, and then drag it to my chosen strike, in this case, 600. As soon as I do that, you'll notice how it dramatically reduces my risk. And what's great is I also have the ability to exclude this leg from my trade temporarily and then re-include it just to compare how the position performs with or without that additional leg. Or if I prefer, I can totally remove that option leg from the trade setup with just one click. Now I'm going to save this trade. It automatically provides a default name, but you can come in and rename it to whatever you like. You can also add notes about the trade and even organize it into different groups for better tracking. Once I save the trade, a couple of key features become available. You can copy the link to this trade and share it with anyone, anywhere. If you send them the link, it will automatically open the trade in the free version of SensaMarket, allowing them to see the trade and review your evaluation. So I've saved the trade, and the final thing I want to show you is this. If you go into your account and click on Save Trades, you'll see the trade we just created. It's listed right here. From there, I can click on Analyze to analyze the trade. And if for any reason I want to remove the saved trade, I can simply click on the three-dot menu and select Delete. So that should give you a solid overview of how to build, analyze, and manage option strategies using SensaMarket. Thanks for watching.